Hi, this is Anes, and in this video we will cover corporate actions risks. Okay, so now it's a lot. We had everything about the market, industries, investment styles. Now we have for earnings risk, we have CEO, politician trades, hedge fund, corporate actions. And actually, corporate actions, it's more than one. Like Anes, what are you showing me? You have stock buyback, stock splits, etc. So let's go through them and see what each one is. So just keep in mind, so there is the onboarding in the app. So see, I did these slides, it was 5 a.m. Okay, you see it here. You see the onboarding in the app again. Corporate actions are usually short-term signals. Again, this is not long-term, okay? So you trade right away, very risky. You close the trade before the hype fades, and long-term you forget about it, okay? But doesn't mean that there is no other long-term signal. It just means that this one is gone. There could be a long-term signal with it, that's fine. But this by itself is not a long-term signal. This just by itself, okay? This is what I mean. Now, first one, stock buys back. Stock buys back, it's easy. Basically, the company buys back its shares, okay? So short-term people buy because it could mean that they believe it's undervalued. And usually it means that, okay? But sometimes it's just because they have extra cash or anything. But clearly, a company would not buy back the share if they didn't think it's undervalued, okay? So people buy back, it goes up, but then the hype fades and it falls a bit again, and then there is no long-term impact, okay? Dividend announcement, very similar. Investors, they love dividends. So especially people who start, they love dividends a lot. So people usually buy dividend stocks. It's fine, like you're happy to get cash, but it also means that the cash cannot be reinvested. Okay, so it's good to keep that in mind. Okay, so ignore this. I just realized that this is not for dividend. This is for another one. Improve liquidity of options and looks cheaper. It's for stock split. Stock split will improve the liquidity because the price of the stock will look cheaper. Because instead, let's say the stock was $100, you split the stock 1 to 5, it becomes 5 times less. It becomes $20. But every stock you own, for every stock you own, you receive 5 stocks if it's 1 to 5. So sure, it becomes 5 times less, but you keep the same value. It improves liquidity for options because options trade on 100 lots. So it becomes cheaper to buy one, even if in fact it's not cheaper, it just requires less cash commitment. But the pricing in terms of volatility of your option is the same. And it brings and it looks cheaper for newbies because if you see something at $20, it feels cheaper than 100. But the reality is that you get the same amount of shares of the company. You get the same proportion, and that's all that matters. It's a short-term impact. It's not long-term. So short-term, when there is a stock split, things will go up, and then it will go down. Okay. Now you have mergers and acquisitions. What is this? Basically, when a company buys another one, what usually happens is that the company that buys thinks long-term. So it's a good long-term deal. But short-term is not such a great deal. You burn cash, the other company is trying to get you at a higher price. And so short-term, people, what they usually do is that they sell the company that's buying. So it's the acquirer, the acquiring company, and they buy the company that's being acquired. That being said, usually what you see is that it prices very fast during the day and then it dips fast. So you can try to do something around it, but honestly I would recommend just ignoring it. Just be aware of what's happening, understand why the stock dipped, and understand that it doesn't always mean a bad thing. Sometimes you see dip, and then as soon as the company releases earnings, the guidance is great because they explain why they think they could profit from the acquisition. So the acquiring company would say, for instance, I'm going to mention now Accenture has acquired an AI consulting firm that specialized in data center. Okay, maybe it's great, like CoreWeave it just IPO'd, it's already worth 80 billion. It's more than Robinhood in like 2 months. The signal to buy CoreWeave. I own the stock. Huh? I bought CoreWeave 2 months ago. I'm up plus 350%. So like, okay, data centers are doing good. Maybe Accenture is going to say, guys, we're going all in on it. The industry is going to grow, and we are going to be the leaders. So like, okay, maybe Accenture is going to go down when something bad when they acquire. It's going to be a small dip, but then long term it has prospects and it could rally with earnings. And same thing with the Hood. So we bought Hoods. I bought Hood last year. It took like it went to the moon. I went so much money, like times 4 maybe. And why? Because they acquired the crypto exchange. So you're going to tell me, okay, well maybe it didn't correlate. Maybe it went up for other reasons. Plus now you have the hype around Hood potentially entering the S&P 500. So it brings also volume. There is indexation risk we should talk about, but yeah. My point is that it's not because it acquired a company and it dipped today with the news that that long term is not going to go up. So again, this is like short term. You see it move. It depends on what the company does after, if analysts believe in it or not, etc. And last thing, private placements. So companies sometimes they sell shares and they dilute the value of the share short term. Often it's small cap companies that do it when the stock already took like times 2, times 3, and they think, okay, doesn't mean it's overvalued, but obviously they think maybe it's a good entry, it's a good exit to sell shares. And so what happens is that when they do, people sell short term. So again, don't panic, don't try to trade this. But what really happens is that they get cash for cheap because it's equity, so they don't have to pay it back with interest like with debt. With bonds, it improves the balance sheet because they get a better debt to equity ratio, they get more cash, etc. But then this cash, they can also use it to fund projects. They can use it to grow the company. Okay, so they are not like paying themselves with it. Hopefully not. If they were, they would get into troubles. But so like if it's Brazil, I don't know. I'm saying Brazil. I have nothing against Brazilian. I used to trade Brazilian books as well. So like I'm very familiar with Bovespa, and I know that sometimes in emerging countries, in general, not just Brazil, any emerging, you can have some scandals. Okay, so in the US, it should not happen because you can more or less trust the data. But again, some funds sometimes short big companies saying, the balance sheet is wrong, they lied, etc. So like even in the US, you're not 100% sure. There's always a risk. But usually it's a good, private placements are usually good for the company long term. Okay, so here I have to say the opposite. Short term, you have no signal, and long term, usually it's good. Okay. All right, so let's move on to the next risks.